Hi, I'm Chris's friend Steve. We like to run hills together. Or I run hills, he watches. But anyway, check this out.
And I know you just cringed. I saw it, I felt it through the wire. But used properly, it is an absolutely unbelievable tax shelter. And in the book that I wrote, I explained ways that I used it, and I actually used it to buy my first home and to start a company. Before you think, oh gosh, sounds like a terrible deal, it makes people nervous, the truth is it is an incredible resource if it's used properly. And so the book outlines ways to use it properly. It has made me more money than any of the other investments I had, especially in 2008 when everything went down except that.
Alrighty, everyone, this is the Money Peach Podcast. I'm your host, Chris Peach, and I'm going to be bringing on some of the most amazing people I can find so they can tell you how they do their life and their money the right way. Today's guest is Eric Brotman. Now, as you heard from that little snippet I just played for you, Eric and I may not completely agree on everything, but we do agree on a lot. And so Eric's coming on the show today to talk about the 4 different strategies to keep taxes off of your money for good. So without further ado, let me bring on Eric Brotman. Eric Brotman, thank you so much for coming on the Money Peach Podcast. I am thrilled to have you here. Before we hit record, we were kind of going back and forth talking about money nerd stuff, and I got all excited and I said, stop, we got to hit record. I don't want to go too crazy here because I want our listeners to get the same passion for money that you and I both have. So thank you for coming on the show.
Oh, Chris, it's great to be here. I've listened to many of your episodes and look forward to it.
Eric, the reason why I wanted you to come on the show is I've heard you on a lot of different podcasts. I love the way you talk about money. We're on the same page on almost everything, which is good. We can't be the exact same page for everything, but we're pretty dang close. Before we jump in and we start talking about this nerdy money stuff, I want to know, how did you go from where you started to eventually landing here on the Money Peach Podcast? How did that happen?
Well, Chris, it was a natural transition from being an English major in college. So you can appreciate how that would lend itself to personal finance.
Absolutely.
I started my career actually in the legal department of a wirehouse, a large brokerage firm, fell in love with the financial world, earned my CFP in 1998, and launched a firm myself in 2003. So we're celebrating our 15th anniversary at Brotman Financial Group here in Lutherville, Maryland. We've grown to 8 financial advisors, 18 full-time people, and I do a lot of media appearances here locally. I'm on NBC News here on Sunday mornings, and I'm real active in trying to educate the community about financial matters and making good decisions. So it's been quite a run.
I heard you on a couple different podcasts recently. On Jordan Goodman's show, he was on our podcast as well, and a couple other ones. And I really like some of the message you're putting out there. But the reason why I wanted to bring you on is I have some actual personal questions that I'm going to ask on behalf of myself, my wife, and I guess on the listeners as well. And I was hoping you can kind of steer us down that direction. So recently, for those of you who are new listeners, we just retired my wife. So my wife was a television news anchor here in the Phoenix area for the last 15 years. Her employer had a 401k. We started putting in that 401k, and we're pretty diligent about putting in the max every single year. The great thing about this bull market is over the last 10 years, when you put money in, it just kept growing. It's been amazing. So now we're sitting there with this 401k. She doesn't work there anymore, but we haven't done anything with it yet. If you're in my shoes, what would you be doing?
Well, Chris, I think one size never fits all, but in general, I do like the control that you are able to have by rolling a 401k into a traditional IRA. I like the fact that you can control your investment options, you control your costs. At no point down the road are you going to be beholden whatsoever to the HR department of a former employer trying to make sure you can go rescue your own money. Once I leave an employer or someone leaves an employer, I tend to prefer going your own route most of the time.
Is it safe to say that most of the time the fees inside 401k plans are higher than if you were to roll it out into an IRA somewhere?
All things being equal, the answer to that is yes. However, it does depend whether you're working with an independent financial advisor or you're working with someone from a wirehouse or a bank or trust company. They're going to layer on some additional expenses. So expense ratios often are higher in a 401k because of the various plan discrimination tests and all the administration. Depending on what type of advisor you use, your all-in cost may be higher because you're getting one-on-one advice. So you do have to look at that. It's not a one-size-fits-all. There are going to be situations where an IRA is a little bit more expensive, and you have to determine if you're getting value for spending that extra money or not.
So, Eric, I get this question quite a bit. People come to me and they'll say, I have a 401k, I'm getting the company match. However, I'm not happy with the funds they have it. I feel like I could be doing better elsewhere, but I feel like I'm stuck. And they just don't know the answer. Are they stuck investing solely inside the funds of their current 401k, or do they have options outside of that?
Chris, it depends on a document called the Summary Plan Description, or SPD, of the plan. Every employer and HR department must be able to provide that for employees. And what that document does is it allows you to understand the rules under the plan document itself. So, for example, in some plans, you're allowed to have what's called an outside brokerage account, where you can actually, within the 401k, have a separate account that's managed by a firm that is still part of the same plan. That would allow you to choose almost anything in the plan. However, recognize that is often very, very expensive. So you have to really know what you're doing and decide that that's worth it. The other thing, and what we see a lot more often, is that when certain people reach various ages, and often that's in your 50s, sometimes it's 55, sometimes it's 59 and a half, but there's a provision in a lot of plans now that allows for an in-service non-hardship withdrawal. And what that mouthful means in English is you can actually make a withdrawal from your 401k as a rollover into an IRA while you're still working for the employer. So it allows you essentially to have both. You continue to contribute to the 401k, you continue to enjoy the match, but typically once a year, if you choose to move some or all of your balance to an IRA, even while you're working there, you're allowed to do it. And there's pros and cons to that, but in terms of investment control, it's a pro.
So investment control, so the cons would be the cost then?
The cost can be a con, but the other thing is that in a 401k, if you're older, if you're 70 and a half and you have required minimum distributions from your IRA where the government says, hey, we've given you this deferral, but now we want our money. If you're 70 and a half and you work for a company and you're not an owner of the company, your 401k is not subject to the RMD rules.
So RMD, just give us an example. You're talking about required minimum distribution, correct?
If you're 70 and a half years old and you have $1 million in your 401k plan, the government requires you to take a withdrawal every year, a distribution that's taxable to you, whether you want the money or not, because they want their money. It's based on life expectancy. There's a uniform table to calculate what this is, but in the first year, it's typically about 4%. So in that case, you're 70 and a half years old, you have $1 million in your 401k, and they force you to take $40,000 out that is taxable income just like a paycheck, and you lose some percentage of it right off the top. In a 401k, if you don't own the company and you're still in that plan, that balance is not subject to those rules. So if you're 69 years old and you're thinking, hey, I may work a few more years, you may want to leave the money in that 401k because it will allow you to preserve the deferral for longer than you could do in an IRA. That's one of the cons.
So I'm learning something as we go. That's why I'm here. Kind of going along with this 401k. A couple weeks ago, episode 114, we had somebody come on the show. She was very anti 401k. And her thing was, she was saying that we're in the lowest tax rate environment in the history of the United States, that we have a $21 trillion deficit. There's a bunch going on in the economy. And she just has this belief system that eventually taxes are going to have to go up. And so she was saying, if you put money into 401k right now, you're saying, I don't want to pay low tax now to pay higher tax later. And so she was really telling people, run from the 401k, but definitely take a look at Roth IRAs. Now, I think a lot of it was maybe shock factors, to like really stir the pot a little bit, which it definitely kind of stirred me up a little bit. But what is your take on a Roth IRA versus a 401k? Where does that come? Like if we only have a set amount of money, we want to invest it. Would it be wise for us to go Roth first, 401k, or what are some of the things we should be thinking about?
Well, first of all, her perspective is not necessarily as outlandish as it sounds. There's certainly those who advocate against deferring taxes for that reason. I would say choosing between a traditional and a Roth vehicle, an IRA or 401k, has a lot more to do with your current income and what your projected income is likely to be. So while I agree that we have a huge deficit and that tax rates may increase, I also know that there are states and other jurisdictions that don't tax withdrawals from retirement assets. So it's not a one size fits all. Again, Chris, I wish there was a single answer. There's not. So typically, Roth IRAs are best for folks who are either in relatively modest income brackets or who are typically a little younger. Folks in their 20s, very rarely, 20s, even 30s, very rarely will they benefit as much from a traditional IRA as they will from a Roth IRA or a Roth 401k. And that's simply because with all that time to defer and all that time to grow the assets, making a tax-free withdrawal is priceless. But here I would submit that in the same way that a guest like the one you had on that episode says, well, wait a minute, tax rates have to go up and there's a certain amount of fear of what might happen and what the government might do. I also share the fear that the government might come back and change some of the rules on Roths after the game's already started too. And I don't think it's unreasonable to say, well, they said Roth IRA assets were going to come out and be tax-free, but what if they decide to means test and throw in a surcharge that's not a tax? In other words, if your account is over a certain size, yeah, we're going to subject you to different rules. And so based on the way the rules are written today, if we're to trust that they never change, then yes, the Roth IRA and Roth 401k for younger people and for lower income people makes the most sense. I don't know whether those rules are going to change. I would love to say, nope, we know the rules and this is the way it's going to be, but tax laws change about 800 times a year. So for me to suggest that I know what the tax laws are going to be in 20 or 30 or 40 years, I don't know what they're going to be in 18 months.
You just hit me up with some truth right there, because I've actually felt a little bit of what you're talking about. So just for our listeners to kind of get their heads around Roth IRAs and IRAs and 401ks, if they're not completely paying attention to this, you're not bad for not paying attention, but if you're not into it like we are, I'm just going to real quick, in my terms, I'm a firefighter, so I break it down into firefighter terms, how a Roth works versus an IRA or versus a 401k, and then you tell me if I'm right. So a 401k, your money goes in pre-tax, means it's not taxed. That's why it lowers your taxable income that year. It grows tax deferred, and then when you're retired, 59 and a half, you get tax on that money when you pull it out. A Roth IRA is very similar, except you just switch the front and the back end. So you pay taxes on the front end, it grows tax deferred, but then when it's time to withdraw it at age 59 and a half, you do not have to pay any tax on that currently. Is that correct?
That is correct. That's one of the core differences. There are others, but that is the core one.
So the core one is just basically you're switching the front and the back ends. You're paying pre-tax, after tax, you're just moving those around.
Well, yes.
And if I'm a little off, correct me, because that's what I'm here for.
Well, the other thing that I would say, Chris, is that the RMD rules, which we just spoke about, do not apply to Roths. So when you're 70 and a half, you're not forced to pull money out of the Roth. You can have that defer indefinitely, and it becomes a spectacular asset to leave to the next generation if you don't need the money. Because while the next generation will have to take distributions, you don't. Whereas the 401k, the traditional IRA, is going to force you to pay taxes on money you may not even need or want.
Because the government wants their money eventually.
Correct. There's no such thing as a free lunch, my friend.
That is correct. So with that said, then, I'm a big fan. I started when I was young of investing in a Roth IRA because I love the idea that, I just remember being told this scenario where, Chris, if you have $1 million in a Roth IRA, you have $1 million. And if you have $1 million in a 401k that's rolled over to an IRA, depending on how much you take, you might only have $600,000. And that to me just blew my mind. However, I will say this, I am a full-time firefighter. And so when I got hired as a firefighter in 2007, the pension was a certain way. And I remember being told, this pension is set in stone. You are golden. Nothing's going to change for you, blah, blah, blah. And so I was like, great. What happened after 2007 is there was a big financial crisis we're all aware of. And the pension looks a lot different today. So you had just said that who knows what the changes might be. There's 800 tax changes a year. Who knows? You're exactly right. I leaned on that information that I was told that first month I was on the job, that it was set in stone. I'll tell you what, that stone definitely molded a little bit differently over time.
Well, I bet it did. And, as much as your listeners might think about or talk about diversification, and you think about diversification, people are thinking about stocks and bonds or asset classes, but there's also tax diversification. And tax diversification means you're going to want some of your assets to be non-taxable in retirement. You're going to want some to be ordinary income, and you're going to want some to be capital gains. And the reason for that is that those rates change constantly, and you want to be flexible. If all of your money is in only one bucket and you can't control your withdrawals or what you're living on, and the government changes any of those rules and it's adverse to your bucket, you got a big problem. Whereas if you have tax diversification and you have lots of different types of assets and types of accounts, and all of a sudden there's a year where capital gains rate is 0 for some reason, well, heck, you're going to start using that account then instead. And on the other hand, if they say capital gains are no longer getting a special rate and you're going to pay ordinary income plus 10% because we said so, well, then you'll avoid taking money out of that account. Knowing what the government's going to do, we don't. We don't ever know what they're going to do. We do know that the federal government's running a giant deficit. We do know that it is highly unlikely that tax rates are going to get lower. But that may not be true at the household level just because it's true at the national level.
So that's a very good takeaway is diversification, not one or the other, but maybe a mixture of both. So you have that diversification in place when the government decides we're going to go from A to B or do something or make a change. You can hedge against whatever the negative would be in that position for you. Whatever is going to hurt you, at least you have the upside on that as well.
Well, that's exactly right. And you can participate in both a traditional and a Roth in the same year. Now, there are limits that are going to be capped and they're going to be on a macro level, but you could do both. So in my personal situation, my wife and I both fund backdoor Roth IRAs every year. And we could talk a little bit about how that works, but we both get money into a Roth IRA every year, but I'm also maximizing my traditional 401k. So that by having both, I'm creating tax diversification, I'm reducing my current tax bill, and I'm setting myself up to have some assets that'll grow for the next 30 years and never be taxed again, assuming the rules stay set.
Yeah, let's go down that road real quick because it's helpful for me to understand it even more. So I understand that once you hit a certain level of income, whether it's a single income or married filing jointly income, you have to backdoor into a Roth IRA. We've had to do this in the past as well. I say just the word backdoor, but I'm going to ask a professional, what does that mean when somebody says they're going to backdoor their way into a Roth IRA?
Backdoor is in quotes. It's not the most elegant term in the world, I'll grant you. But essentially what this means is your income dictates whether you can make a Roth IRA contribution. But your income does not dictate whether you can make a conversion of IRA assets to Roth IRA assets. So the way a backdoor Roth IRA works, and there are certain circumstances where it works great, at any income level, you're allowed to make an IRA contribution. You're not necessarily allowed to deduct the contribution, but you're allowed to make one. So if you're in a high income tax bracket, you can make what's called a non-deductible traditional IRA contribution. And you say, well, why in the world would I do that? The benefit of an IRA is I'm getting a tax deduction on the deposit. Well, in this case, you give up the tax deduction and the money stays in the IRA. Now, if you were to leave it there, when you were to withdraw 20 years from now, the amount of your contribution that was non-taxable would be your basis, which means that portion would come back to you as a percentage non-taxably. But in most cases, that's not a great deal. So instead, you take that IRA with the non-deductible contribution amount in it, convert it to a Roth, and when you do a conversion, the basis in your traditional IRA, which means the amount you've contributed after taxes, moves into the Roth tax-free because you've already paid your taxes. Once it gets into the Roth, it will then grow tax-free and be treated just like a Roth IRA so long as you hold the account open for 5 years.
Is it fair to say, just in like simple terms, that if you do the conversion, you are going to pay taxes on whatever you're converting from the traditional IRA to the Roth IRA?
Except for your basis. So if you have $20,000 in a traditional IRA and all of it was put in pre-tax and you convert to a Roth, you're going to pay taxes on that $20,000 that year. And the only way you want to do that is if you have the money to pay the taxes outside of the plan, because you're not going to want to withdraw from the plan and pay additional taxes or penalties if you're younger to pay the tax bill. So you take $20,000. Let's say hypothetically you're in a 30% tax bracket. The $20,000 moves from the IRA to the Roth IRA. The Roth IRA now has $20,000 in it, but the IRS sends you a love note saying you owe us $6,000 for the 30%.
Gotcha.
However, if you have that $20,000, but you make a non-deductible contribution to it, such that now the account is, let's say, $32,000 because you made a couple years of contributions, or $33,000, when you convert it, you're only paying taxes on the amount that went in pre-tax, not the amount that went in post-tax.
Because there's no double taxation.
Correct.
Hey guys, I just wanted to pause and take a second to say thank you from me to you for listening to and supporting the Money Peach podcast. Without listeners like you, this show definitely would not be possible, so thank you. You know, the number one question that I receive is this: Peach, I just don't know where to start when it comes to my money. You know, so many of us out there are living paycheck to paycheck. We have tons of debt. We're not making any headway. We can't save any money. We want to go on a freaking vacation where we pay cash for it. Oh, and let's talk about retirement savings and kids' college planning on top of that, right? Where do you start? Well, that's why we created the cash flow formula. The cash flow formula is the same system that Andrea and I used to pay off $52,000 in debt in only 7 months. And the best part is it's 100% free, meaning we are going to send you the free tools and a free lesson on how to set up your own cash flow formula. So to get started, go over to getcashflowformula.com. That's GET cashflowformula.com. Once again, head on over to getcashflowformula.com to get your free copy and your free lesson on how to get started the right way. All right, guys, now back to the show. Speaking of taxes, before we hit record here, you said you were going to give our listeners a free ebook. And this ebook is going to walk them through the 4 different ways to keep the government off of your money. Is that correct?
That's correct. There are 4 ways that most Americans can utilize to put money away in places where it will, at least by current law, never be taxed again. I wrote an ebook and published it at lowtaxbook.com, and it's available for download anytime. And there are 4 strategies, and the Roth IRA is one of them.
We talked about the Roth IRA. That's number 1. What's number 2?
Number 2 is the health savings account, or the HSA. Now, the HSA does have some restrictions on the purposes for which it can be used tax-free. But if used correctly, money goes in, it grows tax-deferred, and it comes out tax-free, so long as it's used for either medical care or long-term care premiums or other things. And one thing we know is that as Americans, we spend about half of what we spend on medical care in our lifetimes, we spend in the last 6 months of our lives. So the reality is taking that and holding it in the HSA until we're much older is just good tax planning. It's smart. And if you happen to not need it for healthcare, you can pull it out and it's taxed just like an IRA. So essentially, it's an extra IRA for you.
Is there anything else like that out there that has that, I would call it triple tax savings, where it goes in tax-free, grows tax-free, and comes out tax-free if used correctly?
Not to the best of my knowledge. That's the best one. That is the panacea of all tax planning, so long as you use it for its intended purpose.
It just blows my mind that the government actually allowed us to create something where they get nothing if you use it correctly.
Well, they get nothing except, remember, the government's concerned about Medicaid and what it would need to spend if you don't have savings. This is not the government being thoughtful. This is selfishly motivated as well, because if you run out of money, the government's going to wind up, at least at the state level, taking care of you, and that costs taxes and resources. So they wanted to create an incentive for people to take care of themselves.
Gotcha. That makes sense. Okay. So number 1, Roth IRA. Number 2 is the health savings accounts. What's number 3?
Number 3 is a 529 plan, which is for college savings. And similar to an HSA, it can grow tax deferred. And so long as it's used for education, it can come out with no taxes on the gains or on the principal. So again, it has some restrictions, but used properly, it is a tax panacea. You don't get a tax deduction at the federal level for contributions, but you might at a state level. And so you need to know what state of your residence is and what plans are available to you. The other thing that's great about 529 is that people forget, and that makes this so powerful for grandparents or even great-grandparents, is that you can park a bunch of money in those accounts. You name your kids or grandkids as beneficiaries. They never own the account. It's not a gift. You own it. You control it. You could still withdraw from it and take your principal back with no tax if you chose, but it stays outside of your estate for tax purposes, and it doesn't hurt the kids as much on their FAFSA because their parents are the ones filling out the FAFSA form. So that's the federal financial aid form. If you have grandparents who are benevolent and have money that's laying around that they expect to wind up leaving behind, they can either leave it in a 529 for their kids or grandkids. Because of beneficiary changes, it can even be held for their generations. It never has to be taxed.
We're a big fan. We have a 529. We open one for each kid and we own it. My wife owns one and I own one. But I did not know that. That was one thing that I wanted to ask is, what are the contribution limits? If you're saying you have somebody that has, a bunch of cash and they want to leave behind, what does that look like?
You're allowed to do what's called 5-year gift averaging. Let's say a grandparent, because the annual gift tax exclusion is $15,000 per donor, per donee. So if you have grandparents, they're both living, there's 2 of them, that means for each grandkid, they can put away $30,000 a year into a 529 and allow it to grow. But what they can also do is they can put 5 years worth in the account up front and then not contribute for the next 60 months, the next 5 years. You could have grandparents ostensibly put $150,000 in each of the grandkids' plans up front with no gift tax, growing tax deferred for the rest of time, so long as it's used for education. And it doesn't have to be used by the initial beneficiary. It could be used by their kids.
Our thing was, what if our son gets a scholarship, or what if our daughter doesn't want to go to college for some reason? Is that money, are we just kind of out of that money? Or do we, and they said, no, that could be an incentive for them, get a scholarship so their kids' college is paid for. Is that the kind of the way you're explaining it?
Well, it could be that, or it could be get a scholarship for undergrad and it'll pay for law school. So there's that option. Not only can it roll down to the next generation, used properly, it could even send you back for your career change. When you give up firefighting and you decide to get that PhD you've been thinking about, you could use it yourself.
Gotcha. So it doesn't have to just go to who it's intended for in the very beginning.
Correct. You can change beneficiaries once a year. And so who the beneficiary is on those accounts has no bearing on who owns it or controls it or how it's used or invested or even withdrawn.
Wow. I've had this thing for, I don't know, 5-6 years now, and I'm still learning more about it. So I'm definitely going to have to get a copy of this book. But before we jump to the book, I want to say, what's number 4? We got Roth IRA, HSA, and 529 so far.
Number 4 is whole life insurance. And I know you just cringed. I saw it. I felt it through the wire. But used properly, whole life insurance is an absolutely unbelievable tax shelter. And in the book that I wrote, I explained ways that I used it. And I actually used it to buy my first home and to start a company. Before you think, oh gosh, whole life insurance sounds like a terrible deal, it makes people nervous. The truth is it is an incredible resource if it's used properly. And so the book outlines ways to use it properly. It has made me more money than any of the other investments I had, especially in 2008 when everything went down except that.
So you're one of the few people I've ever say yay or that said yes on a whole life insurance. I mean, it's like, I would say it's like 97 out of 100 say no. So I need to dive in a little further and just kind of get the overview of how this has benefited you so much.
Sure. I believe if you're using whole life insurance as a place to park cash that's designed to grow and to grow tax deferred, you then have, number one, a permission slip to be a little more aggressive on your other investing because you have this safety net. So that can make a difference. And number two, you have the ability to be your own bank and to create your own collateral. When you look at the cost of loans and the cost of money in a whole life plan, most of the time, a loan against a whole life contract is 8%. And you say to me, well, Eric, 8% is a lousy deal. I can get 4.5 or 5 over here. And you'd be right, except that this 8% uses the insurance as collateral. It's not a withdrawal. So that if the policy is still growing by 5.5% or so, as most of them do, your net cost of that money is only 2.5%. And there's no principal call on it, which means it makes it a low cost way to leverage your own money. And so used properly, like I said, it was the down payment on my first home that ultimately I paid back and sold the home for more than I had paid for it. It was seed money when I started a company, and that's, after 20 years or 15 years, that's paid dividends in tons of different ways. And it is one of the very few assets that cannot go down in value. It's not an investment, and it shouldn't be looked at as an investment. It's not the vehicle you want to use for college or for savings. And there's so many gimmicks, and there's so many ways to use it wrong, and it's expensive, and people hate it. But used properly, those who have it are so glad they have it. I'll give you another example, and that is for Social Security offset. So you and your wife both have Social Security, and presumably you'll collect at some point, 67, 70, whatever it is, right? When one of you is widowed, the lower of your 2 Social Security payments is going to go away. You'll keep the bigger one. There is a guaranteed pay cut to one of you when you outlive the other. Using whole life insurance that is paid up, where you're no longer writing checks for it after a certain number of years, using that, it can offset that pay cut when one of you is widowed, no matter who it is. Let's say your wife outlives you. I don't know the age disparity or anything else, but Chris, I'm knocking you off first. Your wife outlives you. She collects the higher of the 2 Social Security payments. She collects your death benefit from the whole life, whatever's left after anything you've used. And then she uses her own cash value because she no longer needs the death benefit. So she uses that as tax-free income. Used properly, a whole life insurance policy is like a Roth IRA with no contribution limits. Used improperly, it's an expensive vehicle. Used properly, it's a limitless tax shelter.
So would you recommend a whole life policy to like a high net worth individual that has a lot of cash that they need to put somewhere? Or are you saying for everyone?
Well, it's definitely not for everyone. I mean, I think you have to hit certain targets first. We would never suggest that everyone should have these. But for folks who have already met their retirement savings target, so in other words, if we went through and said, Chris, you've got to put away 18% of what you make for the next 15 years, and then you'll hit financial independence. If you've already got that track, then this becomes a nice add-on for a use of some of your emergency funds, some of your capital, or even to replace what might be fixed income or bonds in your portfolio. I don't know about you, but with interest rates going up, bonds, they're not going to look great with higher interest rates, at least not currently. So why not be in something where you participate in rising interest rates, which we haven't seen in this country for decades, but which we're starting to see now?
I'm still not 100% sold. I'm definitely bent in that direction. I'm going to have to do a lot more research on it before I come out and say yay on a whole life. I'm trying to challenge you, and you're making some valid points that's hard to challenge. So I will say that. All right.
Well, know that I'm coming from a place where I don't work for a life insurance company. So this is not company speak. I am merely recognizing that this is an asset that used properly creates incredible multi-generational wealth and no taxes.
So Eric, what's the name of the book?
The book is found at lowtaxbook.com, and it's for 4 strategies where you won't have any taxes ever again on your money. We just talked about all 4 of them. You may or may not agree with all of them, but if you read the book, I hope you'll let me know.
Well, I would say the majority of things I read out there, I don't necessarily agree with. I read to learn, I read to expand. So I will definitely read it. And I can tell you right now, 1, 2, and 3, Roth IRA, HSA 529, not only do I agree with them, I use all 3 of those. We have been for a while. Whole life, I'm still bending on it, if you will. I'm still molding towards that way. Someone who's been anti-whole life for a long time, it's going to be hard, in a 30-minute show to say, okay, I'm on board, but you're definitely opening my mind to the point where I'm going to look into it, because as you were speaking, it was hard for me to come up with challenges because every time I was thinking of one, you answered it. But Eric, this was a fun show. I learned a lot. I mean, it's kind of silly that I have some of these investment strategies in place and I'm still learning how they work because I guess, like you said, X amount of times a year, the government changes the way they tax us and the way they run taxation on us. So it's definitely interesting to learn some of these loopholes, some of these, what did I call it? The unprofessional backdoor, right? That's
Correct.
the firefighter talk. But conversion is definitely a much better word. But Eric, where can our listeners find more about you?
Our website is brotmanfinancial.com. So that's BROTMAN financial.com. A lot of information about our firm, as well as the ability to download our books. I've published 2 traditional books in addition to the ebook, and there are a lot of resources there for consumers.
Anything that Eric and I talked about, we'll put links in the show notes to the book, to his website. Anything else that we mentioned, we're going to put links in there. So once again, Eric, just wanted to say thank you for taking the time coming on the show. We really appreciate you.
My pleasure. I enjoyed it as well. Thank you, Chris.
And just like that, we wrap up another amazing episode of the Money Peach podcast. All the show notes, the links, and even the book Eric's giving away for free can be found over at moneypeach.com/session117. That's moneypeach.com/session117. Thank you guys so much for listening to the show. Thank you for the support. Have a great week, and God bless you.
Boom,